Good day. Today, the 5th of October, the second day of MINEX Forum. And we have the possibility to talk with Johnathan, Director, Equity Research, RBC Capital Markets. RBC Capital Markets is participating in MINEX Forum 2011 as silver sponsors. And during MINEX Forum, there is much talk on gold, on prices of gold, on valuation trends, and your main work is connected with valuation trends for gold mining. And what is the present situation in this sphere?
Well, it's been a very exciting year for the gold price. Gold touched its highest level ever about a month and a half ago. And that's obviously been driven by concerns about the Eurozone, concerns about the sustainability of the US deficit, and very strong demand for gold from a physical perspective coming out of the Asian nations, most notably China and India. So yes, it's been an extremely good year for gold.
What are the forecasts?
At the moment, we're forecasting a gold price of $1,600 for 2011, $1,800 for 2012 and 2013, and we go back to a long-term price of $1,200 post-2015, and we set that long-term price by where we believe that the current marginal cost of production is for the gold mining industry.
And how do Russian mining companies fit into the present situation?
Russian mining companies tend to fit in at the lower end of the valuation spectrum at the present time. So they typically trade at a premium to the South African gold miners, but at a big discount to the North American listed gold mining companies, people like Barrick and Newmont and others.
Okay, and now in Russia and all over the world, we have some situation of instability. Everyone is talking on possibility of crisis repeating. And how can mining companies and investors somehow evaluate and manage risk in such a situation of instability?
I think the first thing to remember about the gold price is that gold does very well when there is a marginal increase in risk appetite. When the world goes completely to pieces, as it did in 2008, the gold price actually pulls back and people buy US dollars. Now, that may not be the case in 10 years' time, but it is the case today. So from an investment point of view, we believe that any pullback in the gold price over the short term, perhaps stimulated by problems within the Eurozone, represents a buying opportunity. And that's what we think has happened in the last month or so, with gold pulling back from $1,900 to nearer $1,600. If you look at the historical relationship between gold and US M1 money supply, there is for every 1% increase in US M1 money supply, there is a 0.9% increase in the gold price. If you carry that relationship forward, that suggests that gold will go up to $2,300 an ounce over the next 12 months. So despite the fluctuations that we've seen over the last month, we do believe that there's still a fundamentally strong story for gold as a metal. Whether that translates into the equities is a different question. We believe it will do, and we believe it will do because when people start publishing their third quarter results over the next month and a half, you will see very, very strong cash flow generation by the gold mining companies. And over the next 3 years, we expect to see a period of consolidation for gold. At present, the top 10 gold miners only account for 40% of global production. That's far less consolidation than there is in other parts of the mining industry, such as iron ore and nickel. So it's an industry that's ripe for consolidation. We expect the top tier miners, the tier 1 gold miners, those that produce more than 1 million ounces a year, to generate more than $36 billion of free cash flow between now and 2013. So there is plenty of cash to stimulate a round of consolidation within the gold mining industry. And so we believe that will support and drive on equity valuations over the short and medium term.
Thank you much. And the last question, how do you like MINEX 2011?
I think it's a fantastic event. It's very well attended, and I look forward to coming back in 2012.